Okay, let's dive right into this. Welcome to today's explainer. Today, we're looking at something that, honestly, feels a little bit like corporate magic, but it's actually just everyday accounting strategy. We're going to explore how a company can legally, and I mean dramatically, change its bottom line, alter its reported profits, and even shrink its tax bill, all without selling a single extra product. Crazy, right? It all comes down to the way a company counts its inventory. We're going to decode the manager's dilemma by looking really closely at two acronyms you've probably heard of, FIFO and LIFO. And then we're going to see how this actually plays out in the real world with the famous Merrimack case.
Here is our roadmap for today. First, inventory cost flow assumptions. Second, calculating FIFO and LIFO. Third, the manager's dilemma. And finally, number 4, the Merrimack case study. Let's get started.
Section 1, Inventory Cost Flow Assumptions. To really understand this, I want you to imagine for a second that you're a middle manager. Your entire job is buying goods from suppliers and turning around and selling them to your customers. You're the person right in the middle.
Think about what actually happens to the stuff you buy. When you purchase merchandise for resale, it just sits in your warehouse. In accounting terms, it sits on your balance sheet as an asset called inventory, just holding its value. But the exact moment you sell that merchandise to a customer, a transformation happens. The cost of that item flows directly off the balance sheet and onto the income statement. It literally becomes an expense, specifically called the cost of goods sold. But here's the trick. When you're buying items at different prices all throughout the year, which specific costs flow over when you finally make a sale? Well, we need an assumption.
And that brings us to our first method, first in, first out, or FIFO. Under FIFO, we act like we're selling our very first absolute oldest purchases before we even touch the newer ones. Think of a grocery store selling milk, right? They always put the oldest milk at the front of the shelf so it sells first, leaving the newest milk in the back. Well, FIFO assumes your costs flow exactly like that. The oldest costs go to your cost of goods sold expense, and the most recent costs stay behind in your ending inventory.
Now contrast that with last in, first out, or LIFO. Here, we assume the very last units we purchased, the newest ones, are the first ones out the door to the customer. Imagine a pile of gravel. When you buy more gravel, you dump it right on top of the pile. When you sell gravel, you scoop from the top. You're selling the newest stuff first. Under LIFO, the most recent costs go to your cost of goods sold, leaving your oldest, original costs just sitting there in your ending inventory.
Moving on to Section 2, calculating FIFO and LIFO. Let's transition from the theory to the actual math. I want to set up a real scenario so we can see exactly how these two methods differ when we start crunching the numbers.
So, consider our purchases for this period. They fall into 3 different buckets. Our beginning inventory was 400 units that cost us $10 each. Then we purchased 500 more units, but notice the price. It went up to $12. Finally, we purchased another 300 units and the price rose again to $14. So we have 1,200 total units available. Now let's say we sell 700 of those units to our customers. Because of inflation, the prices are rising from $10 to $14. We need to calculate the expense, the cost of goods sold, for those 700 units.
First up, let's guide you step by step through the FIFO calculation. Remember, first in, first out means pulling from the top down. To get to our 700 sold units, we take the entire first bucket, 400 units at $10 each. But we aren't at 700 yet, so we need 300 more. We dip into the second bucket and pull out 300 units at $12 each. We multiply and add those together, giving us a total cost of goods sold of $7,600. That leaves 500 units left over in our ending inventory. Specifically, the remaining 200 units at $12 and all 300 units at $14. So that leaves $6,600 remaining as an asset on our balance sheet. Okay, now let's apply the LIFO method to the exact same situation. Last in, first out means pulling from the bottom up, the newest purchases first. We start with the newest bucket, 300 units at $14. We still need 400 more units to hit our 700 sold, so we go to the next most recent bucket and take 400 units at $12. When we multiply and add these together, it results in a much higher cost of goods sold of $9,000. Under LIFO, our remaining 500 units of ending inventory consist of the oldest, completely untouched buckets, our 400 units at $10 and 100 units at $12, totaling $5,200.
Now what's really interesting here is the sheer contrast. We sold the exact same 700 physical units to our customers. The reality in the warehouse didn't change one bit. But simply by choosing a different accounting assumption, we've created a massive dollar difference. FIFO gave us an expense of $7,600, while LIFO gave us an expense of $9,000.
Section 3, the manager's dilemma. I want us to pivot from the pure math to the strategic reality of the business world. Step into the shoes of the boss for a second. You are the manager, and you have to pick one of these methods to report your financials during a period of rising inflation. Which one do you actually choose?
Listen to this quote straight from our source material. If the prices keep going up, you want to report lower cost of goods sold. It will make investors happy. But if you care about tax, your tax will be lower under LIFO. This highlights the fundamental tension literally every manager faces. It's a total tug of war between appeasing Wall Street and preserving your cash from the IRS.
Let's break down this rule of contrast. If you pick FIFO during a time of inflation, you report a lower cost of goods sold. Because your expenses look lower, your net income looks higher. This gives you what we sometimes call phantom profits. Your earnings report looks absolutely fantastic, and your investors are thrilled. But a higher net income means the government wants a bigger cut, so your taxes go up. On the flip side, if you pick LIFO, you pull from those newer, more expensive buckets. Your cost of goods sold is much higher. This slashes your net income, which might upset some investors, but it legally and significantly shrinks your tax bill, keeping cold hard cash away from the IRS and inside your company.
All right, Section 4, the Merrimack case study. Let's see how this all builds into a real-world application, because this isn't just theory. Companies navigate this dilemma all the time, and sometimes they decide they need to completely change their strategy.
To set the scene, the company Merrimack had been operating under the LIFO method, but for the year 2008, they decided they really wanted to report higher net income. Maybe they wanted to look more profitable to investors or secure better financing. To pull this off, they are making a major move, abandoning LIFO and switching over to the FIFO accounting method. But okay, here's where I've got to warn you about a common trap door that so many students and novice analysts fall right through. When a company switches its accounting assumption for a new year, you absolutely cannot just copy and paste the old LIFO beginning inventory balance. For Merrimack, their old ending inventory under LIFO was $13.5 million. It is incredibly tempting to just grab that $13.5 million to start your new FIFO calculations. But the reality is, switching methods means you must adjust the past. You actually have to pretend you were using FIFO all along. And the secret to doing that always lies buried in the financial footnotes.
When we dig into Merrimack's footnotes, boom, there's the reveal. The footnote states that if Merrimack had been using FIFO all along instead of LIFO, their beginning inventory wouldn't be $13.5 million, it would actually be $19 million. This $19 million is the number you must use to start your new calculations. You have to restate that beginning inventory, or literally the entire year's calculations will be fundamentally wrong.
We've seen how tracking inventory isn't just about counting boxes in a warehouse. It's a profound strategic choice. So I want to leave you with this provocative thought as we wrap up. If a company can legally change its net income, alter its tax bill, and paint an entirely different picture of its profitability just by switching an accounting assumption on a piece of paper, what does that really mean for the hard numbers we see reported on Wall Street every single day? It certainly makes you look at an earnings report a little differently, doesn't it? Thank you so much for joining me for today's explainer, and I'll catch you next time.